I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today is December 14th. Big announcements this week. It was inflation and the Fed rate. The Fed spoke just yesterday and really affected the interest rate and bond market. So we want to go into that and why that is good news for homeowners, people who want to take cash out on their refinances. Not a lot of people are lowering their interest rates yet.
But debt's increasing,
and
people are tapping into that house equity in order to pay that off. And, I always tell Ed, we sound like a bunch of geeks, because all we talk about is the Fed and, 1 BIP here and, 30 year there and 10 year over there. And we don't typically look at this stuff in a microscope until probably the last year and a half. Just because of the impact of what the market has done to these interest rates.
Yeah.
So hopefully a couple of years from now or a year from now, we won't be talking to this granular level.
Yeah, I think it's like,
but it's a big deal.
Like when the market's in pain, and generally speaking, you could say that the interest rate market and then the pain of like this real estate, like it's an unusual time. This is kind of like
the homeowners are in pain. They're sitting in their home.
You go to the doctor and you're trying to figure out what's wrong, and when will I feel better?
Yeah, when will I be able to breathe again?
Yeah.
The air quality is just bad and we don't know when it's going to get good. That's like you being in your home wanting to move and you just can't because interest rates are high. So that's why we're focusing on this stuff.
Okay, so remember, this is for informational purposes only. This is not financial advice. Let's go really quick over the interest rates where they're at today. And again, things are moving quickly, but this is from the Mortgage News Daily, the 30-year fix at 6.82%. The 15-year fix at 6.29.
The 30-year FHA, 6.23, and the 30-year VA, 6.25. VA and FHA are always very close.
30-year history back to 2017. Just want to show you a view of this over the last 6 years, and you can see where rates in 2019 kind of peaked around 5 and then went down to the lows of that 2.75 for the 30-year fix. And how far we've come. And I remember this is the fastest rate of increase that you've ever seen. Mm-hmm. Well, it's been like, one of the,
I think in the last 40 years.
Yeah, I've recorded, history on this. And this is what it looks like. If you look back, you're like, oh, wow, we were, obviously rates were higher in the 1980s and 90s. But this just gives you a better perspective of the slide, how over 40 years, we've been on a consistent downward path. So even though these last couple of years have been up, the long-term trend has been down.
Yeah, we've called it our interest rate slide. Mm-hmm. It's not an interest rate whoop-de-doo.
Yeah.
It's not an interest rate rocket. No, it's a slide because you can look at it over 40 years. It has gradually been coming down.
We want to make a quick note about inflation. The CPI, which is that inflation number, came out on Tuesday, December 12th. And the forecasts and the actual release numbers. So the market always forecasts what the release will be. And sometimes the forecast is not, they're off. Maybe the actual release is higher or lower. And this came in right at the forecast. So the inflation reported year over year. So that is the November 2022 to November 2023 is 3.1%. That includes food and gas, and then without food and gas, they say the inflation's at 4%.
Mm-hmm. So the actual came in at what they forecasted, which is a little bit unusual. Usually they're off a tiny bit.
Yeah,
but so that was good news.
There's not much to report there, but we wanted to go into something that is really important to know. Now, a quick note about inflation. Inside of the inflation number, that CPI number, is the shelter. And shelter is anything that's a housing expense or rent.
Right, whether you own or rent, it's still a shelter number.
And when they look at the inflation number, which was 3.1%, that's the total inflation, inside of that number is the shelter accounts for 34% of it. Okay, 34%.
Okay, so a third of that number is housing.
Yeah.
Okay,
that's right.
So that's a big deal. A third is a big number.
A third impact. Yeah, it has a third impact.
Okay. Now, and what's that third? What was the inflation number on just that third?
Crunch the numbers at 6.5%. So the shelter alone was 6.5%.
Right. So you're telling me a third of that number was actually double what that number was.
Yes, that's right. And so if you took out this number, I didn't do a slide on this one, but if you took out the shelter from inflation, that everything else would be about 1.7%.
Wow.
So inflation without shelter about
that almost seems too low.
Yeah.
But okay. Well, that's a big deal.
So the Fed meeting was yesterday, and the Fed rate noon Arizona time came out and said, the rate was unchanged. And here's what's important to know here's an important question. Why did the bond market or the interest rates in general go down when the Fed rate announcement said or did not move? When the Fed rate did not change rates.
Yeah. Why did it go down?
Why did it go down? Why did everything else go? Why did the bond market improve? The rates improve?
Well, yeah. So the Feds are giving us clues and hints as to what's going to happen in the future. And so all these guys do is they sit around trying to figure out what is going to happen in the future. And based upon what Jerome Powell said, they call the word dovish. They heard more dovish language, nicer language from the Feds, which means they are basically topped out and that they're likely going to start lowering interest rates next year. They don't know when, but they're going to start lowering them, which was really, really big news.
So it was a relief. I mean, the investors in the market, the big money movers and the banks, they were really relieved, and immediately the yield started going down.
Yeah.
Now, this is the CME group from Chicago. This is a futures for market, and you've seen this chart before, but we show this a lot. It gives us an idea of these are the Fed meetings over here to the left. January 31st. Is the next meeting. So yesterday was
a month and a half away.
December 13th to January 31st. Next meeting, there's an 83% chance. That's what this means. 83% chance that we'll stay. We're currently in this bracket right now. This is where the Fed rate is, at 5.25 to 5.5. 83% chance it'll be unchanged.
Hold. So, and they've been unchanged for the past 2 Fed meetings, right?
Oh, yeah.
Okay. At least 2.
At least two.
Yeah. So we're saying is there's going to be yet another meeting coming up next month. It's going to be unchanged.
Yeah.
There's a much higher probability it will remain unchanged. Now these forecasters are starting to forecast out. Well, what about, March? What about May? What about June? Those months.
And we see for the first time a pivot. Since rates have gone up, the first pivot maybe going down is going to start that meeting March 20th. 66% chance that it will go down a quarter. And there actually is a 12% chance, you can see this over here to the left, 12% chance that it'll go down 0.5%.
Okay, so and we've talked about this before. So you can see all these different probabilities going all the way to the end of next year. The pricing is already assuming these things happen.
Yeah, the pricing in the interest rate market today
is already assuming that in September of 24, there is a 50% chance that they're going to be at that 400 to 425 mark.
Yeah.
Okay. So what's important to know is that if the Feds deviate from this, or if the market deviates from this, anything, good or bad, it can change things.
That's right.
So they're literally going out 1 year from now and saying, this is what we think it's going to look like today. But tomorrow, it could be different. The next day, it could be different.
Yeah, and we see that through this year, this continual slide down. That's at least the bets, and we're going to continue to monitor this. The Fed rate and the 30-year fixed rates. These are in the red of this chart is showing you the Fed rate, the history. And the Fed only meets 8 times a year, so it isn't like it moves every day or every week. It's really 8 times a year when they meet, and sometimes they don't change the rate for years. I mean, we can see this period between 2010 to 2019.
15?
15. Okay, glasses.
Yeah, it was almost basically flat. And so back then, we wouldn't have ever been talking about the Feds.
Yeah, it would have been really boring.
Yeah, but super boring, even more boring than it is now.
So we have the 30-year fix in blue. And one thing is what we wanted to just say, and we've been done this before, the Fed will come out and move first. Like this is what the Fed kind of sets policy. The 30-year fix, the 10-year bond, all these other interest rates move as kind of, they're affected by the Fed rate.
Yeah.
And
yeah, the feds don't affect it directly, but indirectly they absolutely affect it.
yeah, so that's why we can see on this chart the movements are very similar. They're correlated. They moved up and down together. And one of the things that Tom and I have been looking at is the Fed rate, where we're at today. This is the red line, is the Fed rate. Now notice where we're at today on the right, the very far right. We're right at this inflection point that we've been at 1, 2, about 3, 4, 5, 6, and it's pivots. Doesn't mean it always goes down. Sometimes it goes up, but it is a kind of a popular point.
Yeah, it's kind of a nice resting spot. Yeah.
Yeah. And the question is, where are we going to go now? And Tom and I, based off of everything we see, it makes sense. The Fed, the way what's kind of like being teed up, the way that the Fed has been speaking, the way we see it in the bond market, we do see that this pivot will, if that at this point right now, could very well go down. It would make a lot of sense.
Mm-hmm. Yep, exactly. And the other thing we talked about is the feds just don't make pivots in vacuums. They just don't wake up one day saying, hey, let's go up or down, randomly. No, the market is what basically tells them what they need to do to keep things in equilibrium. So they will be watching the market with the market and seeing how things go. So when we do start to see, this pivot coming, we tell people it's not going to all be, roses and ice cream cones. It's just going to mean that there's some cracking going on, and the feds are going to try and get ahead of it by reducing interest rates so that companies can buy stuff and can prop that market back up.
Yeah, that's right. And then Tom and I, we're going to be very alert to the news and what's happening. We're looking for some big news that should move the market. We don't know what it is yet. And I don't think anyone knows what it is, but we're just waiting for eventually some type of news that we really kind of supports the narrative that rates are going to come down.
Yeah.
Because we're waiting for that event.
Now, there is also the scenario where inflation comes down and the market still just hums along. So you have inflation right where it needs to be and a market that's just humming along. Again, don't know exactly how that would happen, but that could happen, which means rates could stay the same. So people call us, do you think rates are going to come down? Yes, we do think rates are going to come down. But is it possible that they're going to stay at this, elevated state for longer? Could be. But we don't know. It's all on what the market will be telling us.
All right. Well, be sure to subscribe, comment, like, call us anytime you want to talk about a loan scenario or a question you have. Tom and I are here to help. We're mortgage brokers right here in Phoenix, Arizona.
All right, folks. Hey, thank you.
Take care.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.